Understanding open market operations, OMOs. Open market operations, OMOs, are a cornerstone of monetary policy implemented by the Federal Reserve, Fed, the central bank of the United States. By buying and selling government securities, the Fed can influence the money supply, regulate interest rates, and ultimately foster a stable and growing economy. In this article, we delve deeper into the intricacies of OMOs, their types, objectives, and impact on the economy. What are open market operations? Open market operations refer to the buying and selling of government securities, primarily U.S. Treasury securities, in the open market by the Federal Reserve. The primary objective of these operations is to regulate the amount of money that banks hold in reserve, thereby influencing the availability of credit throughout the economy. Key objectives of OMOs. 1. Regulate the money supply. By purchasing securities, the Fed injects money into the banking system, increasing the overall money supply. Conversely, selling securities removes money from circulation. 2. Influence interest rates. OMOs are a powerful tool to adjust the federal funds rate, the interest rate at which banks lend to each other overnight. This rate serves as a benchmark for other interest rates in the economy, influencing everything from loans to mortgages. 3. Stabilize economic activity. By manipulating interest rates and the money supply, the Fed aims to mitigate economic fluctuations, addressing issues like unemployment, inflation, and overall economic growth. Types of open market operations. The Federal Reserve employs two main types of OMOs: permanent open market operations and temporary open market operations. Permanent open market operations. Permanent OMOs involve the outright buying or selling of securities to manage long-term growth. The primary goal of permanent OMOs is to maintain an appropriate money supply. Buying securities, this adds liquidity to the banking system, lowers interest rates, and encourages lending, leading to increased economic activity. Selling securities, this reduces the money supply, raises interest rates, and discourages borrowing, thereby moderating economic activity. Temporary open market operations. Temporary OMOs are executed through repurchase agreements, repos, or reverse repurchase agreements, reverse repos. These operations are short-term and designed to temporarily adjust the reserves in the banking system. Repos. In a repo, the Fed purchases securities from a bank with an agreement to sell them back at a specific future date. This temporarily increases the bank's reserves. Reverse repos. In this case, the Fed sells securities and agrees to buy them back later, reducing the bank's reserves in the interim. These transactions are crucial for daily liquidity management and ensure that the banking system meets its reserve requirements. The role of the Federal Open Market Committee, FOMC. The FOMC is the principal body responsible for formulating the Fed's monetary policy. The committee meets regularly to establish a target for the federal funds rate. Based on economic indicators and forecasts, the FOMC then decides whether to conduct OMOs to achieve its objectives. Expansionary versus contractionary monetary policy. The Federal Reserve can adopt either an expansionary or contractionary monetary policy based on economic conditions. Expansionary monetary policy. When the goal is to stimulate the economy, the Fed will execute expansionary OMOs by purchasing securities. This increases the money supply and lowers interest rates, leading to increased lending and spending by consumers and businesses. Contractionary monetary policy. If the Fed aims to cool down an overheating economy, it may engage in contractionary OMOs by selling securities. This reduces the money supply, raises interest rates, decreases borrowing, and curbs inflationary pressures. Benefits of open market operations. 1. Stabilization of prices. OMOs allow the Fed to control inflation or deflation without government intervention directly. By adjusting interest rates, the Fed can influence consumer behavior, spending, and investment. 2. Mitigation of economic cycles. During economic downturns, OMOs can stimulate demand by lowering borrowing costs, while during booms, the Fed can sell securities to temper excessive growth. 3. Support for job creation. By promoting an environment of favorable borrowing conditions, OMOs can lead to increased investments and job growth within various sectors. Examples of open market operations in action. In response to economic crises, such as the 2008 financial crisis and the COVID-19 pandemic in 2020, the Fed intensified its use of OMOs to maintain liquidity in the financial system. For example, the implementation of numerous repo operations in 2020 ensured that banks had plentiful reserves and facilitated smooth functioning in intricate financial markets. Open market operations versus quantitative easing. While OMOs are a routine part of monetary policy, quantitative easing, QE, is a non-traditional policy tool employed during times of acute economic stress. Unlike standard OMOs, which typically involve short-term maturities, QE entails large-scale asset purchases, including long-term government and mortgage-backed securities, to inject liquidity into the economy when interest rates are already low. Conclusion. Open market operations are a vital instrument of U.S. monetary policy, enabling the Federal Reserve to maintain economic stability and promote sustainable growth. By understanding the mechanics of OMOs, including their types, objectives, and implications, we gain insights into how monetary policy shapes our economy on a macro level. As the global economic landscape continues to evolve, the importance of OMOs in fostering financial stability and addressing cyclical fluctuations remains a key focus of the Federal Reserve.